Hi everyone, welcome back to Corporate Decoder, the place where we try to make sense of the wild world of corporate finance. And guess what? We've got a fresh S-1 filing from Trailblazer Accession Corp. And let me tell you, this one is packed with enough cautious language to make a lawyer blush. Okay, so Trailblazer Accession Corp is basically a company with a fancy name and zero history ready to go public through this offering. What they're really doing is trying to find another company to buy or merge with and then take that company public without all the usual IPO hassle. Think of them as a sophisticated shell company looking for a sweet deal. And the story here is pretty simple. Trailblazer is aiming to raise a cool $200 million by selling units at $10 each. Each unit gets you a piece of a Class A ordinary share and a sliver of a warrant. W million of these units, so that's a lot of pieces of paper changing hands. Now here's where it gets interesting with any shell company. Our sponsor, Trailblazer sponsor LLC, holds a bunch of these founder shares. They got them for practically nothing, like $0.0 in Portechasse a share. This means they're going to make a fortune if the company actually pulls off a deal, even if the combined company tanks. This creates a bit of a conflict of interest where they might be tempted to do a deal just to cash out their initial investment rather than what's best for us, the public investors. When they do find a company to merge with, they have a strict deadline, usually 24 months to make it happen. If they don't, they have to return the money to investors. This ticking clock is a huge pressure point pushing them to make a deal happen, even if it's not the best one. Let's dive into the financials as of June 2025. The company is still in startup mode with virtually no assets. Their total assets are a measly $4,367,500. This highlights their reliance on this offering for any cash. The key number here is the $200 million that will be held in a trust account. This is the money set aside for buying another company or returning to investors if they fail. It's meant to protect us, but it also means this money isn't actually being used by the company to generate revenue. Now let's talk dilution, the killer of investor returns. The founder shares owned by the sponsor are a huge factor here. Even if the company's net tangible book value per share is negative after the offering, which it is at, after the combination, the sponsor's initial investment of practically nothing becomes worth millions. This means our public shares are likely to be diluted significantly, especially with those founder shares that convert at a nominal price as be diluted significantly, especially with those founder shares that convert at a nominal price. There's a whole section on taxes and it's a minefield. They mention passive foreign investment company rules, which can hit US investors with hefty taxes and complex reporting. The bottom line is investing in this company might have some very unexpected tax consequences, so definitely talk to your tax advisor. It looks like there was a typo in the financial statement analysis as the percentages add up to more than 100%. This isn't a deal breaker, but it's definitely something to be aware of when you're looking at the numbers. It's a small detail, but it makes you wonder if they're as meticulous as they should be, especially when hundreds of millions of dollars are involved. The risks are extensive. You could lose your entire investment if they don't find a business to buy. Nasdaq could even delist their securities, limiting your ability to trade them. Plus, there are all those potential conflicts of interest between the management team, the sponsor, and us, the investors. Our sponsor and management have agreed to waive their redemption rights for their founder shares. This means they are fully committed to making a deal happen and won't be pulling their money out if things look shaky. They're all in. The leadership team is a who's who of finance and business with impressive backgrounds. Eric Semler, our CEO, has a strong track record in tech and media investments and has served on several public company boards. Tad Smith Jr. has a resume that reads like a who's who of corporate America. Eamon Smith, as CFO, has a solid accounting background, and Steven Silverstein has extensive retail experience. These guys seem very capable, but their outside business dealings do create those conflicts of interest we talked about earlier. Now, looking at Trailblazer Accession Corp. On its own, it's a blank check company, which means its success hinges entirely on its ability to find a good acquisition target and then successfully integrate it. The biggest strengths are the management team's experience and their network, which could help them find promising companies. However, the critical weakness is the inherent conflict of interest from the sponsor and the ticking clock to find a business before their funding is returned to investors, combined with the potential for significant dilution to public shareholders. The risks are substantial substantial, and as always with SPACs, there's a real chance that the whole venture fizzles out and investors get their initial investment back but miss out on the potential upside they hoped for from a successful business combination. Alright, that's our breakdown of Trailblazer's S-1 filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for more exclusive content and discussions. Thanks for watching. See you next time.